The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is Esther Gulius, the tax lady from EG Tax, and this is our hour to talk taxes. And so you got to be kind of in the middle of it right now anyway. It's February the 15th, so we got till April the 15th. And if you have any questions, we'd love to hear from you. Our phone number is 803-0930. 803-0930, star 930 on a cell phone. You can text us at 3930, and I drug Chris out of the office. Hey, Chris.
Yeah, kicking and screaming.
You lie. You lie. Because it's nice to get out.
It's nice, and it's nice outside.
And the sun is shining.
Out. Yep.
You know,
Yep.
Actually, I said to my clients, I don't mind 3 days of winter. It's just about been 3 days of
That's
winter.
how I tell my clients. I don't want to hear any complaints.
Boy, I'll tell
and they
you.
go, I know.
That's for sure. That's for sure. Anyway, we're going to talk taxes. I'm from EG Tax. Chris is from EG Tax. We have 32 area offices to serve you. We're open tonight till 9. Our mall in McKinley Mall is open tomorrow. Mall hours. All next week, 9 to 9. If you need the best tax help for the most reasonable fee, EG Tax is something we hope that you will consider. And if you have any questions, you can give us a call, 803-0930, 803-0930, star 930 on the cell phone. 3930 is our text.
Correct.
Okay, so before we get to the phone calls, I always like to talk about a subject, and I wanted to talk about why filing status was so important. But the other thing is, I thought I'd give kind of something that just happened to me this last couple of weeks. Actually, today, many people don't know. They don't seem like they know that they can collect Social Security once they hit age 62, and certainly at normal retirement age, which would be 66.
And a half.
You'd be full
whatever.
retirement.
Yep.
But if you wait till 70, you'd get an extra 32%.
Yep.
So one of my clients today came in and he said his financial advisor said that he should wait until he's 70. So I said, well, that's good. So how much would you be getting? He said $2,500 a month. So that's $30,000. So over a 4-year period, you'd leave $120,000 on the table, right?
Yep.
And, of course, if you die during that period of time, you don't get it, right? But, okay. So, and you will get $9,600 extra if you wait till you're 70. Wow. So it only takes 12.5 years to make up for that $120,000 that you didn't take. And at any point in time during that 12 years, if you pass away, then they don't come to your funeral and say to your spouse, by the way, here's $70,000 that he didn't get or she didn't get, right?
Right.
And what was so poignant today was that one of my clients called and said, she says, Esther, remember the other day me and my husband were in your office and you said, why is my husband collecting Social Security? Because he's over the age of 66. And he didn't think he could because he was still working full time. She said, so that next day we called Social Security and he was starting to collect and he died the next day. Isn't that so sad?
Yep.
And he was a wonderful, wonderful man and young. I mean, he was young and virile. I mean, it was 66, it's true, but he was a really young 66. So,
right.
I mean, you never know when the Grim Reaper's at the front door. So that's what you have to put into consideration. When you are 82 and a half, you'd win if you make it to 82 and a half.
Right.
So that's something maybe your financial advisor needs to explain to you.
Right.
Let's go quick to the phones, and then we're going to talk about why filing status is important. We're going to go to Joe. Hey, Joe.
Hi, Esther. Listen, I sold a personal home,
Okay.
but it was before the 2 years was up, so I have to declare the capital gain.
Okay.
I have about a $10,000 capital gain, and I'm not sure. I've been looking at Schedule B and the Form 8949. Seem very confusing.
Okay, but let me ask you this, Joe. Why did you sell it before the 2 years was up?
Well, just some family situation.
Pardon me?
I didn't. Just a family situation.
Okay, but I mean, okay, so here's the thing. Your 2-year ticker, the 24-month ticker for where it's taxable, partially taxable, If there is a compelling reason why you sold the house without waiting for that 2-year period, then part of that gain is going to be excludable. Right, Chris?
Right. I was going to say, you said for family. Was it for medical reasons, job reasons?
Divorce?
No, nothing like that. We just decided to make the decision. It wasn't any. I did read all those. There was no divorce, no death, no sickness.
So you just didn't like it and you wanted to sell.
There you go.
Okay. Well, then you're going to have a long-term capital gain, and you're going to do the computation on page 2 of the Schedule D. And I don't know what your other income is, but you may pay 0 taxes depending upon if you're under the 15% tax bracket. So you have to do the computation so that you get the benefit of not paying much on your capital gains.
Okay, just at Schedule D, it seemed like everything was about stocks and bonds and stuff.
Well, you see, a home is a capital asset. So when it says description, just put home.
Would we be under we're in the 12% then?
Yeah, you probably are going to pay very little, if anything, at all.
To the federal.
To
New
the
York
federal.
State, of course, is going to get their share.
Right. New York State has no exceptions.
Right. Yeah, well, good for them.
Okay?
Okay.
All right, Joe, thanks for calling.
Thank you.
Bye-bye. I'm Esther Goulias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 3930. Okay? And, why is filing status so important? Let's just say that somebody's got $70,000 taxable income.
Okay.
If you're single, you're going to pay $11,284 in taxes before any credits and stuff. If you're married filing a joint return, the same $70,000 pays $8,015. If you're head of the household, that same $70,000 pays $98.44, and that goes all the way through the tax code. The phase out of a lot of the deductions, the phase out for credits, the percentage you're going to pay is all dependent upon your filing status. So your filing status is very important.
Right. And if you do married separate, and which we do for people who are income-based repayments for their student loans, they get a better payment. So they lose the student loan interest.
Right.
As a deduction.
And if they went to college, they lose
the college
right.
credit. So each filing status has income thresholds and some penalties, we'll call them penalties for married separate, where you lose things, earned income credit.
Right.
You could lose earned income credit.
Well, it was interesting. Last night I had a lovely lady that came in, and she and her husband always file separately. So she pulls out a 1098-T, which means that she went to college. Okay, you got student loan interest? Yep, got student loan. 1098-T. I said, you're going to lose this college credit, and you're going to lose the deductibility of your student loan interest unless you and your husband file jointly. And she said, no, he'll never file jointly because she has debt. She has tax debt. And I said, well, we can do
the injured spouse.
An injured spouse and a non-obligated spouse. And so they'll only take your part of the refund to pay the debt, but he's going to get and all the credits.
Which would be bigger because of the student loans and the education credit. So she would get more money paid to her debt.
So I called her husband. I said, can I call your husband? She said, I don't know why you're going to call. Okay. So I called him and I said, I'm Esther Goulias. I'm sitting here with your wife. And he said, I don't want to file jointly. And I explained everything. And I said, for the last 3 years, we can go back and amend it. You might have thousands of dollars coming back. So he made an appointment and he's coming in. So, I mean, filing status is really, really important. And many people will say, I'm just going to do married filing single. There is no such thing as married filing single. It's single, married joint, married separate, head of household, and qualifying widower. Right. Okay, I'm Esther Goulias, the tax lady. We're going to take a short break. We'll see you on the other side. I got all my sisters with me. Hey, I'm Esther Goulias, the tax lady. Chris is not my sister. He's my son-in-law.
Yes.
Right? Yeah. I'm Esther Goulias, the tax lady from AG Tax. 8030930, 8030930, start 930 on a cell phone. You can text us at 3930. Okay, so when is somebody single, Chris?
When they're legally single on December 31st. Yes.
So if you were married all year long and on December 30th, the divorce is final, what are you for the whole year?
Single.
Single. They don't allocate it.
Nope.
So that's
Nope.
what a single taxpayer is. Now, it's better to be head of the household. Now, many times people think, well, I got myself an apartment and I'm the head of my household. Not right?
You gotta have a dependent child
Or qualifying
or a
relative.
qualifying relative in the house.
Right. So if you maintain a house over 50% of the cost of the house with a qualifying relative, which could be a dependent child, or actually it could be a non-dependent child if you gave the right of the child to be passed on to the non-custodial parent, right?
Yep.
Or a qualifying relative, like let's say grandma moved in and she's being supported by you and she lives in your house and you're single. In that case, you would be able to file head of the household
Right.
and save money
Yep.
and save all those phase outs. So that's really important. Now, married filing separately is something that if you're legally married as of December the 31st, you have the opportunity to say, okay, I want to file married separately. Now, Chris alluded a little while ago how if you have big student loans and you're on an income-based repayment, you might want to consider filing married separately because
Because of reduced payments. Yep. And, and that's the thing. A lot of people, I'm saving money. You're saving money right now. But all those student loans are doing is adding that interest at the end. And then
so
that
true.
interest is adding interest. So you really got to look at the long haul to see, are you really saving
Well, and
money?
the other thing is you got to put a pencil to it. Like, let's say, for instance, you're in graduate school.
Yep.
And you decide that you want to reduce your income-based repayment, so you and your spouse file separately, and you paid $20,000 to graduate school. Well, you'd be entitled to the lifetime learning credit, which would save you $2,000 in taxes, right?
Yep.
But let's say your payments go down $200 a month, which is $2,400. Well, you got to say, gee, am I also giving up something else on my tax return that would be better for me to file separately as opposed to jointly rather than separately? Because am I really that much ahead? And Chris brings up a great point. You still have all that interest accruing.
Yeah.
I guess the best thing is don't create the debt.
Yeah. Yeah.
Right?
And I know, okay, you want to go to school, you want to get that big degree. Make sure you get a job where you can pay the big degree.
That's true.
If you're going to school and you got a master's in writing and you end up with a $30,000 job, you're never going to pay off that student loan.
That's true.
That's what you got to look at.
Well, and we have phenomenal universities here.
Yep.
Just phenomenal. So anyway, that's enough of that. But anyway, and the other thing is qualifying widower. I had a gentleman that came in the other day. He was like 40 years old, and his wife passed away. He's got 2 little children. So this year, he files jointly with her. And next year, because he has children in his home, he will file qualifying widower for the next 2 years, then head of the household. And the benefit is that he gets the
higher
same
standard deduction.
the higher standard deduction and same tax breaks as if he was married filing joint return.
Right. Yeah, we got a text, and this is a very common misdemeanor.
Okay.
Misnomer. Misnomer. That's the word.
Misdemeanor is the
is
bad
the
thing.
Catch and release. Injured spouse. How does it work? We file married filing joint. She stopped working in 2009 due to cancer and hasn't returned to the workforce. Is there a tax credit or something? So
okay, injured spouse means no. It doesn't mean that she's sick.
Right.
Injured spouse means that. Let's say that my husband and I are married joint, right? And I didn't pay my student loans, or I had child support that I didn't pay. So on my balance sheet, I owe money that the IRS and the state of New York can come get. But my husband is clean as a driven snow. But if we file separately, it's going to cost us money. We can lose possibly education credits. We could have penalties for filing married separate. And we want to file jointly because it's the better way to file. Because I have the debt, he would be the injured spouse if they were to take our refund to pay my debt using his money. So we file injured spouse and non-obligated spouse with him saying he's the injured spouse. They would only take the refund pertaining to me, who would have the debt.
Right. Right.
And so that's a way to get your cake and eat it too.
Yep. Yep.
And so for those of you that are out there with that heavy debt and you've been married, you've been filing married separate, look at amending those last 3 years' returns. Going back to injured spouse, you can only do injured spouse on the federal, by the way. You can't do a non-obligated spouse on the state, right?
Yep, you have 10
on an
days.
amended return.
You have
Right.
10 days once they take it. But let's blow their mind away.
Yeah.
Okay. So they take your refund, and you don't want to file together because they always take your refund. How about you switch your withholdings so you owe them $100 each year?
Hallelujah. That's a good That's great. So, all right, so let's say I got the debt and we're filing a joint return and I haven't paid in enough for them to take my refund. I owe them money. Now my spouse has a refund coming, then you do the injured spouse, the refund all goes to my spouse and there's nothing for them to take.
Right. Or even change his withholding to get it all throughout the year.
That's true, too.
So then
That's
there's
true.
really nothing to take,
Right.
and you got all your money.
All your money up front, right.
I mean,
I'm Esther Golias, the tax lady with Chris Fabian, and we're from EG Tax, 8030930, 8030930. Star 930 is cell phone text us at 3930, and we're going to go to Bill in Buffalo. Hi, Bill.
All right, I'm on the phone now.
Hi.
Hi.
What can we do for you, sir?
A couple tax questions.
Yeah.
And since the tax laws changed, and do I still have to keep my deductions, like charitable deductions? Do I still have to count that stuff up?
Okay. So are you single or married?
Married.
Okay. So if all of your itemized deductions, which would be your medical, your taxes, which taxes are capped at $10,000, your interest on your home equity, your charities, your gambling losses exceed 24.4, then you would itemize. If they are under 24.4, then you wouldn't. But on the state of New York, the standard deduction married filing joint is $16,050. So if your itemized deductions exceed $16,050, you'd want to itemize on the state, and you can't itemize on the federal. So many people that I do are itemizing on the state, and a lot of the deductions that they took away when they changed the tax law are still in effect in New York State. So in essence, you do two completely separate types of returns.
Oh, okay. I have another question, if you don't mind.
Yeah.
My friend of mine got an inheritance, and it wasn't life insurance. It was from the pension.
Uh-huh.
So we got $100,000, and they took $20,000 out off the top.
Mm-hmm.
So the next, so is that going to count as his income, or is he just going to have to pay the state on that?
who passed away?
His mother.
And was she over 59 and a half?
Yes.
And was he the only beneficiary?
Well, his brother, but they both got $100,000.
Okay. So what happens is the $20,000 is going to count on the federal return.
He took $100,000, right?
No, he got 100. He only took 20,000.
Oh, is that what you said, or did you say 20,000 in withholding?
No, they took 20,000 out. Right?
Oh, okay. All right.
So the 20,000 counts on the federal. It flows over to the state. Since him and his brother each received this pension or 401k, then they take the 20,000 exclusion that was mom's and divide it by two. So he gets a $10,000 subtraction on
New
the
York State. But it's fully taxable on the federal.
Okay, so right. Okay, so but now that's going to raise his income.
Yeah, because it's taxable.
And so that, but the federal's taken care of. That's not going to. He wouldn't have to pay more, probably, right?
Did he take any taxes out of it?
Well, just the 20,000 that they kept.
So he did take.
So he did
I
take
was
100,000.
Right. If he took 100,000 with 20,000 in withholding, he's going to be very sad. And I'll tell you why. Because he's probably well over the. He's got other forms of income, Bill.
Yeah, but not a lot. He only makes like $30,000 a year.
Okay, but now he's got 130,000. Is he married or single? Single. So at 130,000, so he's going to be 110. Let's see.
Will be 120.
He's going to be in the 24% bracket. So he's going to pay, his tax liability is going to be about
he's going to owe about
$27,000 on the federal, and on the state, he's only going to be able to take off 10 off of that 130. So that means he's going to have 120 taxable in New York State with no, and then he's got a standard deduction about 110. So he's going to owe about $9,000 to the state and about $27,000 to the federal.
Less his 20.
Less his 20. So 7 on the federal, and depending upon what he had withheld from his job, he's going to have a liability about $8,000 on the state.
Wow. Okay.
Okay.
Wow.
Now, wait. Let me say this. But he's working, right?
Yes.
Does he have a pension plan at work?
No.
Then he can do an IRA. You want to hang on, and we'll get you on the other side of the news?
Okay.
All right, hang on. I'm Esther Golias, the tax lady. See you on the other side. Hey, we're family. I'm Esther Golias, the tax lady. And you know we love you. And give us a call, 803-0930, 803-0930, star 930 on a cell phone. You can text us at 3930. And we're talking to Mr. Bill here. All right, Bill. So here's the deal. If your friend or brother inherited this money and he has no pension plan, then he can put, if he's under the age of 59 and under the age of 50, he can put $6,000 in an IRA. If he's 50 or older, he can put $7,000 in an IRA. And in his tax bracket, he would save about $1,600 on the Fed. He'd save almost $2,000 with New York State. So that would cut his bill down a lot.
Oh, okay.
So, okay. And again, if you need any help, we're there to help you. Okay, Mr. Bill?
Okay, thanks a lot.
Thank you, sir. Bye-bye.
And that leads us to what we say all year. People will hear us. Call us before you do anything. Let us run the numbers to see if it's worth it. Because he could have spread that out over 5 years.
Yep.
And probably paid no tax to would have paid little tax to New York State, which would have saved him a lot of money.
Yep.
And then the federal, he could have done an IRA every year and would have, so...
And I will tell you, the lure, when you're having financial problems and you think, I got that pension over there, I got that annuity, I can take it out. What you end up paying in taxes is far, far, far more than you're going to pay in interest. Because, and sometimes you qualify for, if you're between a rock and a hard place and you really can't pay your bills, maybe you should look at a bankruptcy.
Yep.
And pay a little bit, pennies on the dollar, because your pension is meant to be a pension. And they really penalize you if you're under the age of 59 and a half and you take that money. Now, in this case, it was inherited, but taking that whole lump sum, whenever it's going to be taxable, it does not feel good.
Right. And he could have shot himself in the foot because maybe he did have a son, or I know he's had no children, but he could have blown the education credit. He could
that's for sure. And the other thing is, what people don't understand is, like, for instance, with health insurance, you can, for those of you that are on the essential plan, you know that there's that little magic numbers where you won't get the essential plan anymore. The way you can manipulate that is using that IRA. Yep. Like I was just talking to him about setting money aside in a traditional IRA. You have up till April the 15th to do that, and you can eliminate a bunch of your income, making it so that your credits aren't affected as much. Your essential plan isn't affected as much or at all. And so these kind of planning things are really, really important, and that's part of what we do.
Right.
All day long, I'd say to people, now, how would you like to turn your balance due into a refund? And they say, how can we do that? And I say, let's put money in an IRA. I did it this morning with a couple, and they put in $14,000. And they went from owing like $1,000 to getting this really substantial refund because they're going to do $14,000 in an IRA. So
And the
then
money's
people
still
think I'm
theirs.
selling them. You know, they go, "Are you selling?" I'm not selling them. I'm giving you tax
Right.
advice.
Yep.
Okay, I'm Esther Golias, the tax lady. 8030930, 8030930, star 930 on a cell phone, and we're going to go to Sam. Hi, Sam.
Yeah, hi, Esther. Quick question about the 2008 first-time home buyer's credit.
Yeah.
Repaying it back,
Yeah.
like the 7,500 interest-free.
Yep.
The problem is this year I am divorced. So I bought the house with my ex-wife. She's no longer on the house. She tried filing her taxes, and they were rejected because she's still on this home buyer's.
Because she got part of the money,
Right.
so she's responsible for $37.50. So each year it would be $250 from you and $250 from her.
Oh, okay, gotcha. I just wanted to make sure on that.
Yep. All right, Sam.
So,
Yep, that was it.
All right, thank you.
and actually, if she got bought out through the divorce, she should file saying the house, she no longer has the house anymore. So that would stop her half going forward, starting in 2020's tax return. But 2019, she would still be liable.
Okay, but
for it.
how does she do that?
Right on the 5605, there's a box that you no longer have the house
Right.
due to whatever,
Divorce.
divorce or
Right.
sale or.
Right. I'm Esther Golias, the tax lady from EG Tax. All of our offices are open tonight till 9. All next week, 9 to 9. And, of course, on Sunday, you can go to the McKinley Mall if you need help. If you have any questions during the week, you can go to our website, Ask the Tax Lady, and enter your questions in, and I'm happy to respond. But in the meantime, 8030930, 8030930, star 930 on a cell phone. Text us at 3930, and we're going to go to Jim. Hi, Jim.
Hi, Esther.
What's happening?
Like your program.
Thank you.
Esther, I'm 88 years old. I haven't paid income tax in probably 15 years. The only thing I have for income is my Social Security, which with my wife and I is negligible.
Okay.
I have about $1,500 a year on IRA. That's it.
Okay.
This past year, because of some health needs, I bought 2 funerals for my wife and I. And as you know, that money goes to a company that keeps the money until you die.
Right.
I got 2 notices for interest for those 2 funerals this year. It amounts to about, because I bought them only in about the middle of last year, it amounts to about $93 interest. Does that have to be claimed on income?
No, you're good until your taxable income gets to $27,000. You don't have to file, Jim.
Right. You know what I'm wondering? I wonder if I should even file anymore at all.
Well, I don't think you should unless you're doing it for your enhanced star. But the other thing is, let me ask you this: how much do you have total dollars left in your IRA?
About $7,000.
Why don't you just take it all out?
My RMD.
No, Jim. If you just take out your whole IRA right now, the $7,000, you're not. It's going to be completely tax free. So don't worry about the RMD. Just take it all out.
Yeah, the RMD is about $49 a month.
Yeah, I mean, just take it all out.
I could, but I'm not going to do that. The reason is that every year it seems to renew itself. Even though I take out maybe $1,500, by the time at the end of the year, it's replaced itself.
Oh, well, that's good. That's good. I'm just telling you how to take it out tax-free because in the event that something should happen and you pass away, it would go to your heirs and they'd have to pay the taxes on it.
Or go into a nursing home.
Or go into a nursing home. Right. So this way, if you take it all out, you can put it into an investment, which will continue to grow, but at least the principal won't be taxable to your heirs.
Right.
Something to think about.
I could really stop filing, right?
You absolutely can stop filing.
Thank you very much.
Thank you, Jim.
I love your show.
Thank you. Thanks for listening. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Text us at 3930, and we got a text that came in.
We do. It says, I'm retired with no earned income. My wife is still working, earning about $80,000. Can I contribute to my Roth IRA?
Sure.
You can,
Yep.
but why not a traditional?
Yep. You know, now one of the changes that happened just before Christmas, if you're over the age of 70 and a half, you couldn't put money into an IRA anymore. They changed the law. If you're working forever and ever, like those politicians that work until they're 7,000 years old, you can still contribute to your traditional IRA or Roth IRA as long as you have wages. So here's the thing. I mean, if your wife that's working is making $80,000 and she's got a great government job and she's going to get a $70,000 pension when she retires, I would do a Roth. But if you don't have much of a pension, then why would you
and
do
you're
a
going to
Roth?
live on Social Security
Right.
and up in her 401k or something, that you're paying right now. 80,000 married joint is 12%, and they might be in the 0%.
Right.
So you would be paying 12% now to avoid paying no tax later. So to me, I know Esther and I were talking about this before the show.
Yeah, when we were riding over.
We
Yeah.
have a totally different philosophy than financial people.
So here's the thing. People, they're all saying about the Roth. Oh, I got to do the Roth. Now, think about this. There are very few big pensions anymore. Unless you're working for the federal government, state of New York, there aren't any pensions. Everybody's contributing to their own. So if you were able to save $500,000 and you, with life expectancy of 20 years, you're going to take out like $25,000 a year. By the time you get that, right now the standard deduction if you're over 65, married joint, is $27,000. I mean, it means your pension's going to be tax-free anyway. So you put it in a Roth. You got no benefit now, and you're going to get no benefit later. But more than anything, think of our political structure, or whatever you want to call it. I don't even know what you could call it. It's crazy. I mean, you got people saying they're going to tax the rich, and it's going to be that. And we should take over the pensions. I mean, you really don't know what's going to happen. One thing I've learned in tax law: a bird in the hand is worth two in the bush, and some people should do the Roth, but not as many people as these stockbrokers are pushing.
Yep.
Okay. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. Text us at 3930. Then let's talk about itemizing, because it is true the standard deduction is 24.4, married joint, 12.2 if you're single.
Right.
Pretty easy to itemize for many single people, because a lot of single people are homeowners now.
Right.
So you got medical, and what people have to understand, if you got nursing home insurance, that's part of medical. All your Medicaid Part Bs and Ds and Qs, they all get added in there, plus your your deductible, your prescriptions, your ambulance, everything gets added together, and that total is reduced by 7.5% of your adjusted gross income, which they changed. They were going to make it 10. They made it back again to 7.5%. Yep. So that's medical. Taxes would be all your property taxes, sales taxes, or your state withholding, limited to $10,000.
Right, no matter what status you are.
And let's face it, if your state withholding is $3,000 and your property taxes on your house are $7,000, that's $10,000 right there. If you're single, 12.2 is all you have to come up with. So if you got any mortgage interest at all, you should itemize.
Right.
Right?
Yep.
And then your charities. And if you're a gambler, your gambling would then be a miscellaneous itemized deduction.
As long as you won.
As long as you won. You're gambling up to the winnings.
Yep.
And the other thing is that you have to understand is, even if you don't itemize on the federal, you may itemize on the state. Right?
Right. You can still, we were talking with that one caller, because New York State for married filing joint is $15,000 or $16,000.
Right.
$8,000 for single. So you still may be able to.
Right. So if you have somebody with the $10,000 in property taxes and maybe a $6,000 mortgage interest and maybe $1,000 in charity, so they have $17,000 if they're single, for instance, $17,000 they can itemize on the federal and on the state.
Yep.
So that's something you want to look at. So it's medical, taxes, mortgage interest, and the other thing is, which you have to be careful of with the mortgage interest, all the mortgage interest has to be tied to your house.
Right.
So if you took out a loan to pay off junior's college on your home equity, that's not going to be deductible.
Right. Yep. And let's not forget, on New York State, you can still write off your business expenses. your cell phone, your uniforms, your
If you're an
mileage,
employee.
If you're an employee.
Right. Well, if you're either way.
Yeah.
But as an employee, now you no longer can take your business expenses that are non-reimbursed. But on the state of New York, you can still do that. So in essence, you really are doing a completely different tax return, the state to the federal.
Right.
I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. And let's talk about gambling and how it affects a senior's tax return.
Okay.
Because let's say I went to the casino and I hit the jackpot and I got $10,000.
Yep. So
where does that go on the tax return?
page 1 of the 1040.
So what would that do to my Social Security?
Make more of it taxable.
Right, because a lot of people don't know that your Social Security can be taxable if you're single and all of your income plus half of your Social Security comes up over $25,000. Same thing if you're married filing a joint return, half of your Social Security plus your other income exceeds 32. If you have gambling income, even though you lost it, that ends up making your Social Security more taxable. So it's really important that you think twice about going gambling.
Well, now, with it being married and over 65, you said $27,000 is the standard deduction for that couple. If they win $10,000 and say they lost $10,000, they're thinking, okay, I won't pay any taxes, I can write it off. If their only other itemized deductions is their property taxes of $3,000, they're not writing anything off.
That's exactly right. So I don't think that people understand that if you can't itemize, and let's say you had $40,000 in casino jackpots, and you got $40,000 in losing tickets, right? Then your standard deduction, if you were over 65, was $27,000 anyway. So it is true they're going to let you take the difference between the $27,000 and the $40,000, but you're only getting a $13,000 benefit. So you're ending up paying taxes on money that you didn't get.
Yep. And not to mention, what is it going to do for your enhanced star? What is it going to do for your Epic?
Oh, that's really important.
What is it going to do, for your health insurance? What is it going to? It can impact so many different things that people don't realize.
And the other thing I wanted to talk about is for kids that are in college, that let's say they're borrowing money on their own, and mom and dad think that they shouldn't claim the kids because the kids are borrowing the money. Are the children allowed to take the education credit, Chris?
No.
So these kids that think they're going to get the big education credit, they're not going to get it, and they're not going to pay taxes till it exceeds 12.2 anyway.
Right.
So what I always do is I sit down with the kids and I say, look at this education credit for mom and dad saves them $2,900. You, kid, don't get anything anyway unless you cheated, right? And if you cheat, you're going to get $1,000, but that's all you would get. So mom and dad would lose $2,900. You would get if you cheat. Now, why? Explain to them what I mean by cheating.
Saying, "Oh, I'm claiming myself this year, Mom. You can't claim me, so I'm not going to mark that box that says I can be claimed."
Right.
So then their standard deduction doesn't increase, only on this date.
Right.
So they really can't.
Right. So
they're not gaining anything.
They're living in mom and dad's house. Technically, they're being supported by mom and dad, and really they should not say that they can't be claimed by mom and dad because they should. What I say to the parents is, look, you got $2,900. Junior's kicking and screaming here. Give him $1,000, right? Then you guys come out $1,900 ahead. He's got the $1,000. And it's a win-win situation. And if that's your situation, and last year and the year before you had kids in college, maybe they're gone now. Maybe and that was the situation, amend your return because you got money coming back.
Right. Yep. A lot of money coming back.
Right. So what would happen if Junior had gotten the $1,000? You then get the $2,900. You pay back the $1,000. They give you the $2,900. You're $1,900 ahead.
Right.
Right. So, any anecdotes you want to share, Chris?
You just got to be careful with what you're doing. I mean, I see clients all the time that are surprised with the end result of their tax return because they do things without realizing how it impacts them, like you said, with the gambling. But with the filing status, and I'm a component of getting married, but you may really want to think about not getting married.
Oh,
with the
that's true.
current tax law.
People, a client said to me the other day, so tell me about the marriage benefits. Well, I said, there's no marriage benefits in tax law. There's penalties for being married.
Yeah.
I mean, married filing a joint return is just double single, but the thing is married separate on top of everything has all those penalties if you file married separately. So you actually, you'd think that a married couple, they would have doubled single all the way through the tax code. They don't.
Right. Or how about you have two people who live together for years and they have 3 kids, and she has always claimed the kids. She makes $15,000-$20,000 a year. Her refund's $8,000 to $10,000. They get married. He's making $60,000. They lose
the earned income credit. So let's talk for a minute about an earned income credit. The earned income credit basically is a gift from the federal government and state of New York. If you have children that are living in a home that you provide, and you are on the lower end of the income structure, okay, under $50,000, so you can have pretty much up to 3 kids. So they basically are giving you money that you never paid in, and this earned income credit is a lot of money. It's like with state and federal, it can be up to like $8,000 that you never paid in. Plus, you get refundable child tax credits. So some of the money that people are getting are $8,000, $9,000, $10,000, $12,000, and they never paid in a dime because they have minor children living in their house, kids under the age of 17. You can really shoot yourself in the foot if you don't understand what you're doing with your earned income credit, and that's just part of what we do, right?
Right. And so you gotta, I hate to say play the game of the taxes, but that's what.
Well, I said it's a lot like shooting pool.
Yep.
If you do this can happen. If you do that can happen. And you got to know where to make the moves.
Yep.
Right?
Know the
All right, let's quickly go to Brenda. Hey, Brenda, how can we help you?
Yeah, I'm calling because I really agree with what you said. I always said it from the very beginning that when you get married, you get penalized.
In more ways than one. Hey, Brenda.
For married people, because and many of us women, when we got married, we lose so much, and then we still lose because I'm a widow now, and I still, my husband worked for the county, and we were both under the same New York State retirement system. So now with his taxes, I still have to end up paying this year. But however, I was trained to do taxes myself. But however, this year I decided I'm going to do my tax, but I'm also going to take it and have it professionally done, because I think somewhere along the line I'm missing something.
Right.
Because every year I have to pay back taxes. I'm still paying back last year's taxes, and I just really, I really feel
it's always good to have that second look, because just like we were talking about, it's not just the tax return that we do. It's the Brenda, you should think about this, and you should think about that, and have you thought about that, and how about this? Because it's your whole financial picture that's tied to that tax return. So I applaud you, Brenda, for what you're doing. And if you need any help, we'll be very happy to help you, right? Yep. Okay, until next week, I'm Esther Gullius, the tax lady from EG Tax. If you need the best tax help for the least amount of money, we want to help you. To us, your family. Talk to you next week. Bye-bye.